All right, it's 7 p.m. So once again, a really warm welcome to everyone who took your time off your busy schedule to attend this webinar with this very interesting topic for today. So end of this cheap money era, or a lot of us, we also term it as easy money in the past couple of years. After enjoying really many years of low inflation and low interest rates, we are now faced with a regime shift where localization is replacing globalization, aging demographics, as well as a redefinition of work that's driving wages and salaries. Many countries are now reconsidering their energy and food security with government spending crowding out private investments. So investors now are starting to realize that these structural forces are likely to keep inflation elevated, and central bankers are caught between trying to avert a financial crisis and taming the inflation monster. Once again, welcome to this evening of discussion and debate as we chart the likely paths of markets and the economy, and also seeking to identify some of these investment opportunities in this turbulent environment. So this webinar is brought to you by Lion Global Investors. We are very privileged to have Selvin, Senior Director of LGI Curator Portfolios, with us today. And in fact, we have him in the office with us today. Later on, he will give you a brief introduction as well. Myself, Jared, from the digital sales team in Saxo. A little disclaimer, this presentation is brought to you by Saxo as well as Lion Global Investors for your general knowledge and information only. And this would not constitute to any financial or investment advice. And any opinions made here today are subject to change and may be personal. This is the agenda for today. Uh, for the first couple of minutes, we will run through the platform for some of us who are non-clients of ours. Even for existing clients, I will showcase some of these new features we have within the platform. We will conduct a giveaway at the end of this webinar, so do stay tuned. And from the next 20 to 30 minutes, we will have our topic of the day. For some of us, perhaps who are unaware of Lion Global Investors, they are established in Singapore since 1986, a part of Great Eastern Holdings, also a member of OCBC Group. As of 2022, their AUM, assets under management, stands at a $68 billion. And today's Selvin with us, Senior Director of LGI, with more than 25 years of investment experience. He is the head of curated portfolios, where he is responsible for building portfolio solutions for clients as well as partners. So after the topic of the day, we will round it up with a short Q&A session, about 10 minutes long, and we will wrap up and showcase what you can receive, or perhaps how you can win our respective door gifts. So these are some of these door gifts that we can issue to you. A Saxo umbrella, a wireless charger, a premium utensil set, and a bit more from the rest of our partners, as well as a $20 commission credit. So do stay tuned to the end of this webinar to receive a promo code from us. Okay, so with that promo code, all you have to do is to email us, in which I will remind you again towards the end of this session. And these gifts can be collected at our newly opened office. So take the opportunity to come by and say hi to us as well. So I'll take the next couple of minutes to run through our Saxo Trader Go, our award-winning platform, where many of our clients have been using it for their trading activities. For the benefit of some of us who are non-clients, this is how our platform looks like. We have 3 windows at our main trading header. So on top of the trading header, which will be used most frequently, we have a research page where you can gather inspirations, you can look at the news, you can explore the different equity themes we have, you can look back at our webinars and our education segments. All of them will be under our research page. portfolio is where you can zoom into your accounts to look at your history and performance. Okay, so opening up, I would say, as trading with Saxo is as simple as searching for your instrument with our main instrument search bar. For example, Apple. Once you click into it, there will be a product overview where you can look at all these essential information before you start purchasing. And once you're ready, you can click onto the trade ticket, click on trade, and a trade ticket will appear. Key in your order type, the amount you'd like to, the price in which you are looking to enter, the duration, and once this is done, you place an order as straightforward as that. Okay. Over at Saxo, we want convenience to be one of your main driver. So over here, you can simply create multiple watch lists. For instance, I've created one for today's webinar where I input some of these mutual funds which Lion Global has within our portfolio, which we have within our portfolio, which you can simply purchase these mutual funds within our platform. So on top of this, we do have asset classes which are outside of stocks, ETF funds. We have Saxo Select Investments, which is our managed portfolio or managed solutions. Over here, you can see some of these portfolios that we have for our clients for you to invest in, be it dollar cost averaging into this managed portfolio, or if you'd like to, you can do a one-time investment into some of these portfolios. Over here, you can see our partners, Lion Global. They have this Dynamic Growth Asian Perspective Fund, as well as in regular savings plan version, as well as a one-time version. So with that, without further ado, I will pass on my time to Selvin, where he will bring you through the highly sought after topic for today. Over to you, Selvin.
Thank you, Jared, and good evening, ladies and gentlemen. Thank you so much for attending this web presentation. I wish it could have been a live face-to-face, but next time. We are very happy that all of you are here, and we are meeting again to share our investment outlook and portfolio positioning for the Saxo Global Dynamic Growth Model Asian Perspective. I know you have heard a lot about inflation, and we want to share with you our views on inflation and our take on it. Now, we are going to address inflation in three portions or three segments. The first is what we think is driving inflation structurally, peaking globalization. So these are long-term drivers which have dawned upon us and starting to show up in different forms. Now, firstly, I think on the era, I think we lived in the era of rapid globalization, and now that's slowing and peaking. We have all enjoyed super low inflation as global supply chain networks became efficient. China helped fuel the globalization trend with cheap labor, low-cost manufacturing, and of course, world-class infrastructure. And this helped the movement of goods from the east to the west. It kind of gave us a lot of trade surpluses. Asian reserves kind of ballooned. So we actually benefited from it. But after Trump got elected as president, the narrative in the US has slowly changed and started to shift to US reshoring, US inbound investments, and US job creation. Now, the trend continues with the Biden administration as well. If you look at the left-hand chart over here, you can see the green line denoting reshoring and foreign direct investment job announcements. A few examples to drop here. GM, Ford Motors, even Hyundai Motors have all announced that they will open plants in the US, in Michigan, instead of Mexico, for example. And if you look at some of Walmart's suppliers, they are all playing ball with Walmart after Walmart pledged that they will carry more US manufactured products. So, from anything like premium bath towels to outdoor furniture, to textiles, and so on and so forth. Um, Walmart is slowly starting to buy made in America goods. But the big story has still not changed. The big story is that the US is still very heavily reliant on Chinese exports. If you look on the right hand side, you can see that the red line is actually above trend. But one point to note here is that Chinese market share of US trade deficit are obviously fallen from 50, 60% to now about 30, 40%. So that should kind of keep the US administration at bay and keep them a bit pleased that it's not all about China that the US trade deficit is ballooned. But the story is that they are still very heavily reliant on Chinese exports. Now, so the long-term story is that uh, I think we have seen the best of globalization, and globalization kept prices low. And now we are seeing peaking globalization and reshoring happening, and that's a long-term structural factor or force for inflation. Now, the second big uh, inflation structural factor is what we call aging demographics. And we all know that the world is aging, we have aging workforce, and that is also going to cause rising wages, lower labor participation, and that is going to translate into higher wage costs and higher services inflation. Now, China, for example, we know that China's labor force actually peaked 6, 7 years ago already, right? So China has been kind of embarking on automation, trying to improve labor productivity and so on and so forth. But the story is that COVID has made it worse, right? So COVID has actually shaped people's mind about work, quality of life differently. And if you look at the right-hand chart, this is the US labor participation rate. And you can see, especially people at the age of 55 years and above, the participation rate has actually fallen and actually been stuck there. So the story is that there is a shortage of workers, not just in the US, all around the world, and that's causing wage inflation, which is a big driver for services inflation. And that explains why we are still seeing core inflation sticky and not coming down as quickly as what we would like to see. Now, the third force or the third factor of inflation is a little bit controversial, but this is the truth, right? The green transition. So as the world moves into green transition, as more countries pledge for zero carbon emission, of trying to create more green infrastructure and trying to lower the dependence on fossil fuels, you will see that that cost is going to be passed on to consumers. The world is not ready yet. The world is still going through a transition. On one hand, we still have fossil fuels and we are heavily reliant on that. On the other hand, we are spending trillions of dollars on green transition. And what this means that we will see oil prices elevated, and that will translate into higher goods inflation, but we will also see renewable costs, renewable energy, not coming back to parity that quickly, right? So the world is investing in wind, solar, hydropower, but there is a fine balance that the world is trying to achieve today. So the story is that longer term, we are still going to be faced with energy and food prices remaining inflationary. The right-hand chart is got not big logical relationship or logical explanation, but the story is that if oil prices goes down, market thinks that the industrial activity is slowing down and the S&P kind of corrects accordingly, and vice versa. When oil prices go up, the markets do go up. So, while we think that oil prices going up is not a good thing for markets, actually the market works in a very counterintuitive way. So what do central bankers do? Central bankers have to finish their full course of antibiotics, and that's how I describe it. You have an infection, you have to take and finish the antibiotics. You can't stop halfway because you're feeling better, right? So a lot of people are saying that, oh, the Fed is done, they're going to cut interest rates. We are not sure whether the Fed will do that. If you look at inflation, inflation is still a monster, it's still showing its ugly head. And we think that central bankers have not won the inflation war or the inflation fight yet. The Fed still wants to see core inflation coming down to 2%, and I don't think they're going to let off interest rates that easily until we reach that level. So For the record, the last print we saw for core CPI was 5.6%, still way above the 2% mark that the Fed wants to see. And so on the right-hand side, you can see the implied Fed funds target rate. We're going to have one more meeting in May, and a market consensus is that the Fed will hike 25 basis points, and we will see Fed rates going to 5.2%. And so most people say that's the last one, and the Fed is done. And we also agree that it's probably there, but the Fed is going to keep interest rates elevated. And I don't think they're in a rush to cut interest rates, even if we have a mild recession. The markets are undecided. The markets are undecided whether we are in a recession, we are going into a recession, are we going into a hard landing, are we going to a soft landing or no landing, right? So this slide shows it very perfectly, right? So you can see the markets have been toggling between hard landing, soft landing, hard landing, soft landing, and there's no conclusion, right? So every now and then the data comes out, the market kind of makes up its minds and flip-flops. But the story is that this year, the S&P is up 8%, and 80% of that move is driven by just 10 stocks. 10 stocks, stocks like Meta, Amazon, Microsoft, Apple, Nvidia, Tesla, so on and so forth. In fact, we think that the big tech has become even more expensive. And actually, if you look at the technology PE premium against the S&P 500, it's at all-time high. So if you think that liquidity is being drawn away, and the technology stocks got hammered last year and the PE valuations would have retreated, actually we are wrong. In fact, the PE of technology stocks have become even more expensive. And now with that banking mini crisis we saw with the SVB, we actually saw a lot of people hiding in the big tech stocks like Microsoft, Tesla, Apple, Nvidia, because that these companies are immune to the banking crisis or liquidity crisis that SVB is going through. So it's a bit of a quirky market, but it is what it is. Now, on the right-hand side, it's a very interesting chart that we want to explain to you. And I think most of you would realize this by now, but for those who are not familiar, returns have two drivers. One is a EPS growth, and the other one is a PE valuation change. Returns are only driven by these two factors, right? So if you look at 2022, most of the market falls last year was attributed just to a PE valuation change. Why? Because um, interest rates are going up, and as the risk-free rate goes up, markets kind of reprice, and the valuation premium kind of contracted last year. So we saw S&P 500, for example, coming down from 22 times PE to about 18 times PE, right? And if you look at the blue bar over there in 2022, it was nothing much, right? So basically, there was no EPS growth last year. It was all about a valuation change. So markets were down because of a valuation contraction. Now, this year, it's a kind of a reversal of what we saw in 2022, because the market narrative is that the Fed is almost done with interest rates, and maybe the Fed will cut interest rates in the later part of this year. And so we should reverse some of that PE contraction that we saw last year this year. Again, if you look at the blue bar, there's no blue bar in 2023 because 2023 there's no earnings growth, right? So remember, returns are driven by EPS growth, and return is also driven by PE valuation change. So I think for this year, we have already seen the PE valuation change. Unless the Fed cuts, we might see a bit more of PE expansion. But I think the rally that we've seen this year so far, it's kind of a low quality rally, right? We are still looking down the valley, and we are still seeing a chance of a recession coming. Okay, whether it's going to be mild or deep, that remains to be answered. But we think that in a recessionary environment, you will see the blue bar contracting, and that would mean that overall returns will have to be compromised. So over here, our title is that big tech has become more expensive, and we think that valuations are a speed bump. Now let's turn the topic to fixed income. If you look at fixed income, and most people assumed before last year that fixed income is very, very safe, actually it is not true, right? So we saw 2022, the returns were off the charts. Most of the people who invested in bonds were down anywhere from 14 to 17%. If you have invested in Chinese real estate bonds, you're probably down 40 to 50%, right? So fixed income also has risk. It has credit risk, and it also has duration risk. So when interest rates go up or bond yields go up, your duration will hit the returns. And also, if growth slows down and investors think that there is a risk of a credit event happening or a credit quality event happening, then the credit spreads also widen. And that's exactly what we saw in 2022. But I think it's a good reset because now the starting yields are looking very interesting for 2023. So if you're an investor coming into bonds today, you are looking at anything 5 to 6 to 7% returns, or bond starting yields, right? And this is a slide we took from one of our partners, Schroders, and in their presentation, they actually showed that in a soft lending environment, you have two things happening. One is that you will have bond yields coming down because um, it's a soft lending, but at the same time, you wouldn't have a big credit spread expansion. So OAS is an option adjusted spread, and you won't have a big credit blowout. And net net, with a starting yield of 6.4% on investment grade, you can still get away with a 12 to 13% returns. Now, in a hard lending scenario, you might have a risk of a bigger treasury yield decline, and that's good. But you might get offset by a credit spread expansion. So again, you will still get a very decent 8 to 9% returns. And in a low lending scenario, you might just get 1 to 2%. So the story here is the risk reward is looking very interesting for fixed income for us, and we are starting to add into some of these fixed income sleeves. Now, the big question on everybody's mind is this the decade for emerging market assets? And if you look at the left-hand side, you can actually see emerging markets, the red line, has completely underperformed in the last decade, right? So EM, if you had invested in EM assets, thinking that EM assets is where growth is, where China's engine is, you would have been completely disappointed, because if you had just bought into S&P 500, or if you bought into the MSCI World Index, you would have done much better than just staying in emerging markets. Now, the narrative could also be changing because, to begin with, the US dollar is overvalued. And I think most people agree today that the dollar will start rolling over as the Fed finishes its rate hike. And when the dollar kind of eases off, that's a good tailwind for emerging market assets. And if you look at the growth outlook on the right hand side, you can see that the EM or Asia growth or developing Asia growth is much higher than the developed world growth. And I think most people agree that this year we will see a US going into a recession, mild or deep, we are not sure, but it will go into a slowdown and a recession. And Europe and UK could also follow the same way. And that would mean that Asia looks like a kind of a bright spot, and maybe a lot of investors could be hiding in Asia. So I think there could be an allocation away from DM into EM this year and going forward. We think the China story is not over yet. So a lot of people think that, well, China is aging, China's demographics is, not in its favor, and then of course you have the U.S.-China tension. But I think a couple of things are happening in China. For one, we think that middle class consumers are going to be a big driver for growth and for investment opportunities. The aspirations of the Chinese middle class, it's big. Think about the protein intake they're going to have. Think about the branded goods they're going to buy. Think about the education they're going to give the children. Think about the SUVs they are buying or MPVs they are buying, things like that. So the consumer story is a very powerful story, and we think that will continue. The second story is a self-dependent story. As the US blocks a lot of that US technology, chips, semiconductors, and so on and so forth, China has to develop its own technology, its own R&D, and we will see China moving away from textile, toys, shoes, and jeans into high-end semiconductors, DRAMs, aerospace, electric vehicles, batteries, so on and so forth. And another big driver would be defense. As you think about defense security, as we think about geopolitical risk. China is spending big money and a big part of their budget going into defense technology, and we think that there's a lot of opportunities for the China growth story to unveil. And let's not also forget that China is also going through a green transition. We will talk about green transition in the next few slides, but China is a big driver, a big spender of green infrastructure. Clearly, it wants to clean up its environment and wants to prepare for carbon zero carbon emission. So I was talking about green transition. And green transition is the next big money spinner, we think. Think about how much money is going to be spent on the green infrastructure and green transition. Estimates put anywhere between $3 to $6 trillion of annual capex to green the earth, and that would mean that countries, companies, corporates will have to start investing more money into electrification, grids, renewables, infrastructure, charging stations, so on and so forth. And we will also see a lot of other investments in telecom, rail, and roads. And we think that this is where the next opportunity is, um, regardless of whether the Fed pauses here or cuts or hikes, or whether inflation comes off, or whether the US goes into a recession. This secular story will continue in some shape or form going into the next decade. We talked about aging demographics earlier, but we think that modern medicine is going to be one big beneficiary of it. Think about the breakthrough uh, in genome sequencing, in DNA sequencing, biotech, biologics. So more and more molecular medicine is being discovered, and more of this modern medicine is going to keep, aging population even more aged, which also means that people are going to live until 90, 95 years. That's big opportunity for wealth management, for asset managers, for private banking, and so on and so forth. But also means that the aged are going to live a good quality life, which also means tourism is going to benefit, and real estate is also probably going to benefit. AI and automation, we think that this is a breakthrough. Just like genome sequencing in the medicine world, we have today ChatGPT, and we have AI. We've got a lot of technologies today which will solve a lot of our problems. But we don't think this is a threat to workforce or to work. We think these are productivity tools, just like how we had calculators and Excel spreadsheets where our grandfathers used to use abacus, but today our new generation will be starting to use AI and ChatGPT instead of Excel. I think we're seeing on Bloomberg, people are using Python to solve a lot of their problems. So I think AI and automation is going to be a continued play. Again, regardless of whether the US goes into a recession or whether the Fed cuts rates, we think that a lot of productivity gains is going to be reaped out of AI and automation. And I think that more companies are going to be investing in this. So this is a structural play for us. But having said all of that, we still think we are not out of the woods yet. We still want to stay with quality. And if you look at the left-hand side, we have shown you the factor growth or the factor performance of quality, momentum, growth, small cap, dividend value. And you can see year over year, over a longer period of time, you can see quality is one of the best performing factors or styles. Even on the fixed income side, we can see that a lot of the highly rated or companies which got good credit quality tend to also perform very well in terms of performance. So this is our so-called macro outlook, and we think that we should remain sanguine on markets. While we might have a recession, that doesn't mean we should just, sell everything and then stay out, because I think market timing is very difficult to do. And if you miss the best 10 days or best 20 days of the year, then it's going to be quite painful for longer-term returns. Now, we quickly want to give you some color on the Lion Global Dynamic Growth Asian Perspective Model Portfolio on Saxo Select. This is how the model portfolio looks like. And if you look at it in a glance, there is a 75% allocation to equity, and there is a 20% allocation to fixed income, and a 5% allocation to commodities. And this is a high growth, high risk portfolio. So that's the disclaimer, but it's very much globally diversified. So in Asia, we have the Lion Global Asia Pacific Fund, we have the Schroders Greater China Fund, we have the Global X China Consumer Brand ETF. We also have the Lion Global Short Duration Bond Fund. So these are some of the Asian sleeves, together with, of course, the award-winning Lion Global Japan Growth Fund. But globally, we also have allocations to the energy select sector, where ExxonMobil, Chevron, Shell, and those kind of names are in the ETF. We have the automation and robotics ETF. So this is our play into aging demographics, into aging workforce, where we think that as reshoring happens, we will see more investments in automation and robotics. We also have the iShares S&P 500 Growth ETF. Why growth? Because we think that as the Fed finishes off its Fed rate hike, I think some of the growth names could come back and get re-rated. So we have seen technology PE premium going up against the S&P, but growth is not just restricted to technology. We think there's a lot more other growth companies outside of technology, and we want to play that. We still have a long duration treasury 20-year ETF over here as a portfolio balancer or a shock absorber. So you know that if we go into a recession and if there is some systemic risk out there, equity markets will probably fall. But with the equity markets falling, bond yields will also fall. And with this 20-year ETF, we will get a duration pickup, right? So it's a long duration, and with duration and bond yields falling, we will get a nice shock absorber on the other side. And this will probably go up in a stress environment or in a recessionary environment. We have a 5% allocation to gold ETF over here. And so this is how the makeup of the dynamic growth portfolio looks like. Now, in performance, I think we did quite badly in the last 1 year. I mean, markets were tough. Both fixed income and global equities retreated. So last 3 months, we clawed back close to 4.5%. But last 6 months, we clawed back almost 15% from the bottom. So this is also a testimony that this is a high risk, high growth portfolio. And it's designed to benefit from market upswings and structural plays. So we remain confident that this portfolio will be positioned quite nicely as we turn around and as Fed pauses and as we go through the recession and come out, this portfolio for the longer term will do pretty well. We quickly also want to share with you some of the changes that we did in the last 4 months or so. We exited the high dividend, low volatility ETF, and we exchanged that for the S&P Growth ETF. And we also got out of mid-cap ETF. We think that small mid-caps could actually face some pressure as the bank lending standards tighten, as credit availability also tightens. We think that small and mid-cap companies will suffer as we go into a recession. The PIMCO Global Bond Fund is actually a long duration bond fund. We exited that as we didn't want to have too much of long duration. We actually added a short duration Asia credit bond fund. This is by the Lion Global. And we also added the Allianz Income and Growth. This is a very interesting fund. It gives a 7 to 8% dividend yield, and it has convertible bonds, high yield exposure, as well as US equities with a covered call strategy. So these are some of the funds that we introduced into the model. And last but not least, we want to impress upon you that the funds that we are adding into the model, they are big funds. They're not small funds. You can see that the size of the assets under management for some of these funds, like the S&P 500 Growth ETF is a $30 billion ETF. The Allianz Income and Growth is a $40 billion ETF, and so on and so forth. So I've come to the end of my presentation, and I think we can open up for Q&A at this juncture. Thank you.
Thanks, Salvan, for this really insightful information and sharing. Yes, right now we have come to the Q&A period, Q&A section. So do feel free to raise some questions or perhaps one burning question if you do have any. In fact, we do have some that are coming in from the audience. Okay, Salvan. One of it, which is what is your view on the cryptocurrency markets today? And do you still see an opportunity over there?
Okay, a disclaimer that we are traditional fund managers, so we don't invest in crypto as yet.
Mm.
But we do track, and we think that they are also behaving like a high beta asset class. So this year we have seen Nasdaq do very well. We have seen S&P 500 being carried by just 8 or 10 stocks. 80% of S&P 500 move this year has been carried by just 8 or 10 stocks. Can you imagine, out of the 500 stocks, 8 or 10 stocks carry S&P, and they are all very high tech, expensive technology firms. I would put Bitcoin and cryptos in the same basket as expensive, difficult to value. So again, if you look at Tesla, or look at Nvidia, or some of these high tech companies which are very difficult to value, trading at, I don't know, 300 times PE, I would put Bitcoin and cryptos in that basket. So I think the cryptos has performed very well this year, together with some of these expensive tech companies and difficult to value kind of stocks.
Thanks, Selvan. With that, right, what do you think is the preferred, or perhaps maybe for you, what is the most preferred asset class as of this current juncture?
Hmm. We think that fixed income is looking very interesting. I showed you earlier the IG investment grade slide from Schroders. The starting yield, maybe the yield has come off a bit already, but at 5.5, 6% yield, I think the risk reward is looking very interesting for you. Again, there could be some risk because of credit quality, um, but I think that the starting yield is looking very interesting. So that's one part we are looking at. And I think equities overall are actually not very expensive. They're not very cheap either. I would say they are fair value. And if you think about 2023, and I think I showed you the chart where there is no earnings growth. Remember the blue and the red line? There's no earnings growth in 2023, but come 2024, after 2 years of almost no EPS growth, there will be growth in 2024, right? So if you take a longer term view, and if you take the point that the P is not very expensive, then I think global equities are looking attractive on a longer term. Of course, we could go into a valley and come back. So there could be a correction, 10% or 20%, depends on how deep the recession is. But if you can look through that valley, I think equities are looking very interesting, and I think there is potential for growth in that space as well. Again, which part of equities? I think Asian equities are looking interesting, and particularly China and India are looking attractive because of their long-term structural story. China is reinventing itself and moving up the value chain, and India obviously has a very favorable demographic and a big middle class population as well. But the US is also looking very interesting to me because they are very good quality companies. The return on equity in the S&P 500, I think it's the highest among all regions. I might be wrong with the numbers, but I think the ROE of S&P 500 is somewhere in the region of 15 to 17%, which is very, very attractive ROE for equity market.
Sure, we'll definitely bear that in mind when it comes to investing in equities again. And with regards to that, we do have a similar question, or I would say, when we talk about these different countries, with the current geopolitical situation and tensions that is happening right now, how can investors, how can ourselves, we as investors, mitigate any of this, mitigate this risk to our portfolio?
Yeah. So I think the risk is always there, not just geopolitical risk. It could be economic risk, could be a liquidity risk. we could have another accident like what we saw with SVB. As the tide recedes, you will see a lot of skeletons or naked bodies, and we don't know what's more to come. And we think that one way to mitigate that is to have a treasury ETF on the other side as a barbell approach. So gold is one way to think about it. Actually, gold has started to perform this year. You can think about treasury as another, I call it shock absorber, and energy as well, right? So energy is inflation play. And if you think about it, the green transition I talked about earlier, what it means is that a lot of companies are not investing in oil exploration activities. A lot of companies, oil companies, are not drilling for oil anymore, right? They are basically just pumping the existing oil fields. So if the capex or the investments to all this oil exploration is coming off, and this is not a new news, it's been coming off for the last 3 or 4 years, then you can think that at some stage we are going to have an oil deficit. And I think most of us know that the US has been drawing down on their special petroleum reserves, and the OPEC has cut production recently. So we think that the oil is a structural uh, upside case for us. And we are longer term, we are thinking about food security and energy security, not just us. I think governments, countries, everybody wants to solve this. Even Singapore, which is heavily dependent on energy and food imports, are starting to think about energy security and food security. So I think this is somewhere a lot of investments are going to go into as well. But to answer your question, how do we mitigate it? Have a diversified portfolio. Don't put all your eggs in one basket. For example, you can't be putting everything in emerging markets or in China or in India. The world is very, very fluid and fragile. So we like to have a diversified portfolio, play the different growth drivers, and that's what we are trying to do here with this global dynamic growth portfolio.
Yes, so back to the primary principle, diversification is key. Next question. What do you think of some of these opportunities of de-dollarization or the move away from USD as a reserve currency?
Mm.
What are your thoughts?
Yeah. So I think the background to that is the US sanctions against Russia. The world witnessed what could happen if you're not on the US side, right? So basically, Russia fell out on the wrong side, and the US could slap sanctions, and the US could freeze their assets. Um, and the other countries are watching it. China is looking at it and say, "Oh, there is a risk." Iran is looking at it and saying, "Oh, there is a risk." India, Brazil, and so on and so forth. And so, as more and more countries realize that we are overly dependent on the US financial system, let's call it financial system. And remember, the US sanctions also mean you can't operate on the SWIFT system. You can't clear your currencies. So, overnight, you have a problem, right? You can't trade your currencies versus the US, which also means you can't do trade. And again, like what Jared said, the reserves are also stuck, and your reserves could be frozen, right? So there's a lot of risk for countries who potentially could be on the wrong side of the US and face these sanctions. So last year was a good test case, and then so that explains why countries are starting to diversify away from US dollar reserves, starting to trade in their own currencies. I think you saw the recent news of how people are trading in renminbi. But to put things in perspective, 50% of global trade still happens in the US dollars. The world is still very heavily reliant on US dollars. As far as reserves are concerned, there's no other alternative to the US dollars. What do you buy? Do you put in euro? Do you put in Japanese yen? Do you put in renminbi? The renminbi is not a convertible currency, and it's not transparent the way the policies are. So the world doesn't have a choice. But what's recently happening is also people are starting to buy gold. So central banks are starting to buy gold as part of their reserves. So the world is still looking very dynamic. I wouldn't outrightly say that the dollar is going to be or the world is going to be de-dollarized. But maybe this is the beginning, and maybe it will happen over 20 years or so. is not going to happen in the next 3 to 5 years.
Thanks for your input, Salvan. So dollar pretty much right now is still remain as the king position or top position. So I
But
think
but, but
yeah,
can I also make one other point? The point
sure.
is that dollar is actually an overvalued currency
Mm,
on a REER, a real exchange rate policy. That also means that if the Fed is finished with the rate hike and Bank of England and ECB continues to hike interest rates, we're likely to see the dollar come off. I think the dollar has already come off, but the dollar
mm,
will continue to come off. But the reasons are different. The reasons are not because of the de-dollarization, but the reasons are because of the real effective exchange rate regime.
surely. I think we have come towards the end of the webinar. Maybe a last question from our audience. And to sum it up as a whole, any item in which you'd like to further recap on. So this last one is asking for a recap of what are the benefits of investing in emerging markets and which one should we look into or focus on.
Yeah, I think emerging markets, like we showed earlier, I think has underperformed for the longest time, and we think there is a huge potential for a re-rating of emerging markets. So if you look at the valuations, emerging markets is quite attractive at today's level. Of course, there is a big demographic in emerging markets, and if you look at emerging markets, particularly Indonesia, India, looking very attractive, big population, very young population, which means that future investments will probably likely go there. We have Vietnam as well. So I think there's multiple drivers for emerging markets. But again, like I said, don't put all your eggs in one basket. As much as we are positively biased and positively tilted to EM, we are still having a diversified portfolio. On the DM side, like I said, they are good quality companies, good corporate governance. So, although they are not cheap, they are fairly valued, I think, but I think you also need to have some DM assets as well. So in our portfolios in Lion Global, we are tilted to Asia and we are tilted to EM. But that doesn't mean we throw US and Europe out of the window. We still have US and Europe investments. And Japan is also starting to look very attractive from an investment point of view. And I think you must have heard that Warren Buffett has started to go into Japan recently. And Osaka has also approved integrated resort. So they're going to have a casino as well, attracting almost 20 million tourists on an annual basis. So tourism is going to be a big thing for Japan. Currency is very cheap. And I think most of you have gone to Japan and is looking very interesting. So I wouldn't rule out, all of these regions, and we should not, kind of tilt too extremely away or towards EM in our portfolios.
Gotcha, Salvan. Thanks a lot for the information today. Um, coming back, let me share my screen. Okay, so we have come towards the end of the webinar. Do scan the QR code that is on the screen. If you like a recording version of this webinar. And last but not least, this is our promo code for today. The giveaway, all you have to do is to key in this promo code, and the first 10 people to email this promo code to ps@saxomarkets.com will walk away with this our freebies as well as $20 commission credits from us. So any inquiries, do drop us an email as well towards ps@saxomarkets.com. And if you are a new client, or I would say have wanting to explore Saxo platform, it takes 5 minutes to set up an account with us through SingPass MyInfo. Okay. With that, thank you. We have come to the end of the webinar. Always an honor to have Lion Global, Selvin, with us. In fact, my second time hosting with Lion Global Investors. Always insightful, always interesting topics from them. Selvin, any final words for our audiences?
Thank you guys for attending the webinar. I hope you enjoyed it. Let's meet again. Thank you.
A great evening, everyone. Take care and
Good evening.
goodbye.